Hello traders, welcome back. In this video, I will teach you a similar strategy to the one I have taught before, but by using more confluences, we can make this strategy even better. All I want in return is for you to subscribe to my channel. So I'll give you 5 seconds. Go ahead, subscribe to my channel, turn on bell notifications, and if you like this strategy, and if it works for you, just hit the like button. That's all I ask of you. We're going to use order flow. We are going to use SMT divergence. We're going to use kill zone hours, and we're going to use order flow. We're going to use SMT divergence. We're going to use kill zone hours, and we're going to use fair value gap or order block for our entry. That is very simple. So what I mean by that is, first of all, you need to identify the order flow. So let's say on S&P 500, on the 15-minute time frame, we are bullish. We are making higher highs, higher lows, higher highs. You don't want to just go way back and look at the old order flow. You just want to look at the current order flow. You just forget about the previous price section. Just look at this. So prime setup would be this. So you have this liquidity level, and on S&P 500, price takes out this low. And on NAS 100, you have this. And on NAS 100, price fails to sweep that liquidity level. Now, when that happens, that is what I call, or we call, ICT SMT divergence. This is very, very powerful when used with other confluences. When you have the SMT divergence, so what is SMT divergence? It's basically it can be found between two correlated pairs or even three, for example, NAS 100 and S&P 500. Let's assume that if NAS 100 made a higher high, and S&P 500 failed to create another high. Now, this right here is what I call SMT divergence. Or a lot of ICT students, ICT himself calls it SMT. When you have this SMT divergence, you want to trade the pair. You can either trade this pair after market structures shift here, or preferably, what I recommend is you trade the pair or asset that sweeps the liquidity. And then you look for market structures shift on a smaller time frame. And boom. The reason why I teach this thing again and again is that all of the people who are watching this video get familiarized with these concepts, and I don't want anyone to be confused. That is why you will see me repeat these concepts again. It's clear for everyone. Alright, so now when we have SMT divergence, so the order flow is bullish, we are only going to look for longs. Now to identify, it's like a confluence. It's a plus point. This thing can work without order flow. Even if the price action is bullish, you can still look for short positions using the SMT divergence. But the thing is, if you are going to use the order flow and trade in the trend direction, then of course, your vendor is going to be better. So you have SMT divergence on the 15-minute. Now, what you want to do is you want to drop down the 5-minute time frame. Okay. And then you look for market structure shift. Now, if so, let's assume. So if price shifts the market structure, if you have a market structure shift, and NAS still hasn't broke this low right here, then that SMT divergence is valid. However, if price is somewhere around here and it hasn't shifted the market structure, and NAS goes ahead and creates this sweeps out this low, then that SMT setup becomes invalid. Why? Because we did not have what I would say, market structure shift. So that is very important, guys. Repeat. Please rewind back if you didn't understand what I said and watch it again. When you have SMT divergence, let's say on S&P 500, and on NAS, you didn't have divergence at the moment. On NAS, it priced and steeped a low here, but on S&P it did. So when you're looking for market structure shift, it should happen, and then that SMT setup is going to be valid. If price hasn't shifted the market structure, and the NAS 100 goes ahead and sweeps this low as well, then the whole setup becomes invalid because now both of the pairs or assets have swept this low. I hope you understand what I'm trying to say. So anyways, when you have a market structure shift here, now your entry, I'm talking about indices, okay? Now for Forex, you can use 830, after 830. So your entry must be at 830 precise or after 830. Till 11:15, New York time, okay? So make sure you have your chart set to New York time. So now this is my kill zone hour, guys. This is my kill zone hour for Forex. For indices, it's 9:30. Okay, so your entry must be at precise 9:30 or after 9:30 and not later than 11:15. And you should not trade after 11:30. If you have a trade opened, you should close it by 11:30. That is it. So when you have a market structure shift, right? And you mark out your fair value gap right around here, you can take your entry only if the kill zone hours is active. Let's say 9:30 happens here, then you can easily take your entry. Now, the setup around here can occur before 9:30. It doesn't matter. But your entry, and I mean it, your entry must be during these hours. I've seen a lot of people make this mistake. They kept this important part. Actually, it says without time, these concepts, these algorithms don't work. So it's really that simple. So this is the main foundation of the strategy, guys. I teach this thing again and again. So you guys get the grasp of the strategy. I want you guys to become profitable. And all I ask in return is that you subscribe to my channel and turn on notifications and like this video. What I'm going to do now is I'm going to go ahead and show you an example. As you can see right now, I'm looking at US 100 and US 500. But you can look at your USD DXY, Euro USD, PUST. You can look at US 100, US 500, and US 30 altogether, and many others. So you can see right here this candle, and this candle right here. So if I play this through, you can see that the low of this candle was swept right here. And if we look at the auto flow at the moment, I'm going to look to this auto flow. Don't go too far. You can see that we are bullish. So now what you can do now is just take longs. So you can see we swept the low of this candle. And if I play a candle here, you can see we did not. Now what I'm going to do is I'm going to go back. Once that liquidity is swept, I'm going to go back to the 5-minute time frame. And I'm going to look for market structure shift, which happens right here. You can see price sweeps that level once again. If I play this right here, you can see price still hasn't swept liquidity on US 500, so that setup is still valid. Now if I play this through, you can see we have a break of structure just right here. But the problem is right now is we are not in our kill zone timing. Now it's 8:20, right? Price goes ahead and fills this fair value gap. Comes back again, fills this fair value gap again. Now when I pull this through, you can see now we are at 9:30. We have this fair value gap. What you do is simply just go long. Put your stop right below this low or even this low, it doesn't matter, but I would put it here if it was like market. You target a prominent liquidity in opposite direction. Boom. Now that level is swept, what you can do is you can target this level right here. So this would be 1 to 5, I believe. There you go. So that was 1 to 5. Perfect and beautiful trade. So notice how we used kill zone timing, how we used SMT divergence altogether, and used fair value gap altogether to take this entry. This is very simple, guys. Like, trust me, when you keep using this again and again, you're going to become profitable. Now I'm not saying you're going to win each and every single time, but look at this, 1 to 5, guys. No, it's not. So even with a 40% win rate, you can become profitable. It's really that simple, guys, so I hope you guys enjoyed today's video. I will be uploading new content very soon. Happy trading, thanks for watching our video.